Real estate investing can bring big reward and big risks. So know your risks. Welcome to the Real Estate Risk Report, the show for real-world insight on real estate investment risk. Now, here's your host, Lance Peterson.
Thank you for joining the Real Estate Risk Report. I'm your host, as always, Lance Peterson. So today I have with me a good buddy of mine, Todd Pigott with ZINC Financial and the ZINC Income Fund. How you doing today, Todd?
I'm doing fantastic. Thanks for having me on.
Yeah, my pleasure, man. Super excited to get you on the show. I know you're a busy guy. So we'll kind of let you introduce yourself here in a minute, but I've known Todd, off and on now for years. He's a private lender and has a financial business that does things beyond just lending on real estate, and they've recently launched a new fund which we my day job at Verivest, we're the administrators of administering that fund, and they also have joined the Verivest Sponsor Network, so they're gold sponsors. So super excited to be working with these guys. Good group of people. Why don't you share with us, Todd, a little bit about how you got into this business, how you got into lending, and how you've been in real estate for a really, really long time and super active and really built a pretty big enterprise down there in Zinc.
Yeah, so ZINC Financial has been around for about 15, 16, 17 years. We've done probably approximately $1 billion. We're a niche lender. We focus on distressed SFRs, short acronym for single family residential properties. How I got into the business is candidly, my degree was in construction and development out of Fresno State. And then I did some graduate work at UC Santa Barbara. I actually owned a facilities maintenance company. I had about 500 employees in that company. I did that for about 18 years, but that was definitely not my passion. I started that company back when I was playing water polo and swimming for Fresno State, and I needed a business that I could do in my off hours, hence that business was born. Started with myself. We grew that to 500 employees over a period of time, acquired 5 companies, and then I sold it in 05, 06. I wanted to do something that I truly enjoy, realizing that life is very short. And what I truly enjoy is construction and real estate and finance. And so at that point in time, I did a loan for a burned down building in South Fresno. And that was actually the beginnings of Zinc. Prior to that, I had done some rehabs on multifamily as well as SFRs. So I had done some rehab projects prior to that, but more on a part-time basis because I had a previous company. But when I sold that company, it enabled me to take on my full-time passion, which is what I do now. That first project was a burn down, done some rehabs prior. From there, we did a second and a third loan. And to be very candid with you, we've done some other facets of lending. We've done some hard money. We've done some HELOCs and some other stuff in my earlier years, probably in the early 2000s. Those did not work for me, and that's been the basis for my investment strategy today. We're not a non-prime lender. We're not a subprime lender. We require decent credit. We require good liquidity. We require a cash alignment from the borrower. We require them to have experience in the industry. So I've been through my bumps and bruises in the early 2000s, late 90s on what works and what doesn't work. And we've constantly refined that lending strategy. To today, we only have one foreclosure out of hundreds and hundreds of loans. Our portfolio performs at approximately 97 to 99% in the investor rehab space, which is the fix and flip arena. Yeah. So our loan docs, our loan program, our loan platform, our portfolio analysis is at a pretty good exceptional level, and we continue to refine that every day.
Yeah, no, it's great. Yeah, so you had a business, one business, and sort of realized, hey, not the passion, get in. It's been a theme lately on the show where a lot of guys kind of find themselves in that position. You kind of go and do one thing and realize that, hey, I like this. The financial services and the lending and the finance side is more intellectually stimulating, certainly, than some other things. So
I would agree. I'm really lucky because I really like the finance portion of it, the mathematics of it. Did fairly well in math in college, so I like that portion of it. But I also like the fact that what we specialize in is rehab lending, and it's pretty exciting to get out there and put your feet on the ground and take a project that's very messy, and turn it into something that's pretty spectacular. So I really like both ends of what we focus on here at ZINC. It's really a pretty cool job.
Yeah. And for you guys too, I mean, you started sort of in around Fresno, but you've actually expanded, far beyond Fresno. So maybe share a little bit with us, like this, just the acquisition side of a business. Now, I mean, a lot of rehab lenders, it's often very local or regional,
Correct.
right? Whereas for you guys, it obviously started that way, but you found a way to sort of scale it much further and wider, I think, than most people, right? Which is sort of makes you unique, right?
Absolutely. And so there's a couple of defining facts that we choose. And not to get too deep into the trust deed, but there's two types of mortgages in U.S. Soil. There's the mortgage, and then there's the trust deed. And that's the two ways that we secure liens in the United States. And so trust deed is the deed of trust is not actually vested with the borrower. And so the event of a default, you simply record the notice of default and notice of sale, NOS, at the county recorder. You can typically get to that property typically in about 90 days. That's called a non-judicial state. There's no judicial process in order for you to effectuate the collateral return in the event of a default. That's very, very important. Very important. We only operate in states that are trust deed states, so that in the event of a default or calamity that is problematic for the loan, we can get to that collateral in typically 90 days. The rest of the states are mortgage states. That means the deed was actually transferred to the mortgagee or the borrower. But the problem is, in the event of a default, you actually have to go through the judicial process and go to court in order to get that transferred back. That process in some states, Ohio and or Florida, can take years. So number one, my investment strategy is to mitigate risk. We are in 11 states, but we only operate in non-judicial forums where if there's a default, then we can get to that collateral relatively quickly, because my whole investment strategy is around protection of principal for myself and my investors. I have my own capital in this alongside my investors. It's very important to me. I worked very hard for it. So we only operate in some states that are non-judicial in nature. And first of all, secondary, we operate in very geographical regions that are very robust. Communities of 50,000 people or above. They have Targets, they have Starbucks, they have curbs and gutters, good solid single family residential with good income, good employment, and we only focus below the median cost of housing. So my investment strategy to take it outside of California and into these other 11 states is one of principal protection. Non-judicial states, I can get to the collateral quickly in the event of a default. Low-cost housing below the median cost of housing, and in well-defined geographical regions that have solid employment, solid housing, and solid absorption rates. Absorption rates means that's the term used to define that housing is sold relatively quickly when it's listed. So that's kind of, if that helps a little bit, we're very specific in the regions that we operate in, that they got to be non-judicial, they got to have good housing, good employment, they got to have good demand, hence good absorption rate on SFRs, single family residence, below the median cost of housing. I hope that helps a little bit.
Yeah, I mean, it shows. I call it conviction. There's a method to the madness.
There's a method to the madness.
So for you then, like, how do you then get the word out to prospective borrowers in those specific areas that you've targeted? Is it a lot of repeat borrowers, or do you have a strategy as it pertains to like how you acquire that relationship? How have you gone about doing that?
So that's a great question. We at ZINC are not a hard money lender. A hard money lender pays attention to the value of the collateral only, without the ability to repay or without respective credit and other parameters. We're not. I consider ourselves a private money lender. And so a private money lender, we look at both the credit quality of the borrower and the collateral. I spoke a little bit about the collateral, but now it's the borrower. The borrower must have decent credit. They must have decent income. They must have good liquidity. They must have 10 to 30% of the acquisition price in savings in order for them to complete the rehab. So we're very, very specific on the borrower qualifications. We actually have direct access to the IRS, direct access to all three credit bureaus, direct access to the Social Security Administration. We're a lender. We're not a broker. And so with those things, we are very, very selective in the borrowers that we attract. 85% of our submissions here are declined. We only work with the top 10 to 15% of the borrowers. We actively have to go get these borrowers. These are not people that are coming to us that are desperate. These are very skilled real estate investors that have good credit, that have good jobs, and they have good money. They typically invest in real estate 4 to 6 times a year and improve those properties and resell them. We have to go get those people. We use a variety of methods to go and attract those borrowers to us. We use social media. We use some algorithms in some databases where we can find out who bought and resold properties in a specific region multiple times in less than a year. So we'll use those algorithms to go to the county to try to research who's doing it. Google, a variety of other things, and outreach. Finally, 55 to 60% of our borrowers are repeat and or word of mouth. So it's a lot of referral business. So because we are so selective on the borrower that we want to attract, that we're looking for that good credit, good liquidity, good exposure to real estate, unfortunately for us, we have to actually put a lot of effort into going to get those people. They're not calling us as a last resort, and we have a variety of methods to go and attract those guys. So does that help a little bit?
I mean, and I think that it's, it goes back to with all of these things, right? It's like a lot of times it's easy to say, well, I want to invest in some fund that's going to spit out a 7% return or whatever. It's realizing like how that is generated and created it can be very, very different. Right. And I think to your point, like that specificity of saying it's rehab borrowers, it's these things, like these are the things that are constant. This is how we go to market, but not to like money's fungible. I mean, you know this, right? Like at the end of the day, it's sort of like, where can I get the money the cheapest at? Right. And that's what we've seen a lot, especially a lot of people, lenders that are exclusively California, I'm always listening to them sort of, that's always what they're talking about is all this pressures, all this competition, we can't get what we used to get and those sorts of things. And so to be all over the place and trying to serve everybody, I think makes it extremely, extremely challenging to be competitive, not to mention it usually, in my experience, and you can kind of speak to this, right, it puts the lenders in a position where they begin to they become less disciplined and they become more lax and in order to like win business.
That is 100% correct. There's been a lot of compression in competitiveness that's entered our industry over probably the last 3. I've been doing this for nearly 20 years. Candidly, I remember times in San Francisco just 15 years ago where I was the only rehab lender. Now there's 20. I've been in this a long time, and the amount of people that have entered this space recently is very profound. And with that comes a lot of competition. And with that becomes some lenders unfortunately, their duty or their funds or whatever to take on additional risk to try to expand, and I don't believe that to be prudent. I've been through 2 recessions. I've been through downward spirals. A lot of these newer lenders in the last 5 years have not. This discipline is very important to me. We have not moved the needle. We cannot move the needle. You must have decent credit. You must have a cash alignment of interest that's with us that's 10 to 30% of the project cost. You must have exposure to real estate. You must have a clean background, and the collateral must fit our needs. I would rather do 3 deals per month and have them be quality deals than do 6 and gain up market share. It's just kind of where I'm at in my life. That's kind of my philosophy. And so other lenders might choose to gobble up 6 or 9 that month or whatever the situation may be for market penetration. And if that's their model, that's fine. But I think in order to do that, they have to take on additional risk, and they haven't been through some of these downward spirals. I have. They're not fun, and I would rather make sure that my money and my investors' money, I know these people, is protected. So to your point, yes, taking on additional risk can be a very costly mistake here in the years to come. Housing is not going to continue to go at the pace that it has over the last couple of years. It cannot. That is an unsustainable appreciation. So we are going to hit some neutrality here, or some flattening and escalation of housing prices, and maybe even a slight depreciation. I don't think that depreciation is going to be where it was in '08 because we don't have the mortgage products that we did back then. But there is going to be absolute slowing neutrality. I want to make sure I'm prepared for that, and I want to make sure that my investors and the people that I represent, that are my friends and family, don't take on additional risk just for market share. I don't think it's worth it.
Now, in terms of like when you're dealing with the direct borrower, to because ultimately they say, Todd, I love it. I meet all your criteria. I think you guys are great. What are the other things that you guys do to sort of add additional, to make yourselves a more strategic partner to your borrowers, right? Because it does seem that there has to be more than just the rate, right? And it sounds to me like you guys clearly aren't in the boat where you're going to, try to be the low cost leader in a market.
We're definitely not the low cost leader. We can't, and we just won't be. I think that's a race to the bottom, and it invites a lot of problems. We have to be competitive, and we are competitive. We're probably in the middle. We try to. The big thing for us and our borrowers, because we do require that our borrowers meet several stringent standards that we're not going to move on. Well, how can we be of value to them where they want to choose us over another lender that might be more cost effective? So a couple of things: speed, ease, and reliability. We try to make the process quick for them on the front end. We can typically fund our loans in typically 7 to 10 days. We know that once they meet our credit, background, and liquidity, the rest of the metrics, we might be a little bit more softer on that are less important. If they have a bad pest report or they have a bad roof report, I'll tell you, Lance, in 20 years of doing this and $1 billion of lending, I've never had a loan go south because the pest report was bad or the roof was bad. So I care less about those things. I care more about borrower quality, because if the guy has good credit, good liquidity, good exposure, that loan isn't going to go south over a $7,000 pest. So we try to move the needle on the softer things that over our $1 billion of lending we haven't had exposure to, but we're strict on the things that are very important to us. So speed, ease, and reliability on the front end, and then on the back end, we try to help them with a little bit closer monitoring of the project. Once that funds, the portfolio performance is very important to us. We do job site inspections. We mandate color photos. We basically, in essence, partner with them on the process. So we try to help them throughout that process to make sure that their project is moving along, insurance is being maintained, that our disbursements, because we disperse the rehab funds when those items are completed and installed, that we try to get those to them within 24 hours. So if the cabinets are installed or the painting's done, if we have evidence of that by way of paid receipts and an inspection report, we disperse that via ACH. We electronically deposit that to them in less than 24 hours. So where we try to create value for the borrowers is saying, hey, look, once you get over the major hurdle with us of credit, liquidity, and exposure to real estate, and you know what you're doing, we'll waiver on the couple of things that are less significant, like a pest report or a roof. And by the way, once it's done, we're going to get you your control funds very quickly, typically within 24 hours. And that's going to help you get your project moving, because the whole thing about this is your project needs to keep moving. So we try to provide value. I would call it overall customer experience, moving what they need quicker and faster than some of our competitors, because again, we're not going to take on additional risk on the borrower qualifications or the collateral qualifications. So how can we make up the difference? Let's help them get their money faster on the rehab. Let's help them through the origination process with things that aren't so critical to us.
It helps a lot.
I hope that helps a little bit.
That is the world we live in. The consumers rule. And I was just having a conversation with a colleague this morning, and it's just like,
yes, they do.
We're talking about the car buying process, and it's realizing that they're borrowers and they have to meet criteria. To your point, meaning that equals friction, potential friction for you. It means that they may not meet the criteria or whatever.
Correct.
How do we make it frictionless? Yeah.
So how do we overcome that? How do we overcome that? Because at the end of the day, and I tell this to my investors all the time, candidly, the borrowers dictate the rules, not us. We can have everything a lot of people that are new to this don't understand that. The borrowers are dictating the rules, not us. We can do everything that, as a lender, we can say and do everything you think you want to have, but you just won't have any business. And so there's a balance there. We want to do business, but we want to do good business and provide value You
Yeah.
know, it's a balance.
Yeah.
It's a
No,
balance.
it
If
does.
that
I mean,
makes
and I think
sense. Yeah.
that it's finding that balance and realizing that the borrower is your consumer and that they do have those controls and making their lives easier. Because once again, you both want the same thing. You want a successful project. You know, they're going to acquire a real piece of real estate and they're going to rehabilitate it and they're going to sell it for a profit. You both want the same thing.
We both want that same thing. So how can we help them with that rehab process get through that faster? We have our own full-time in-house control fund department. If that draw request comes through, we are on it usually within 6 to 10 hours to get an inspector out there, get the color pictures, and get them their money via ACH. We want to help them get it quickly. That's where we try to provide the value.
Knowing you, it seems like your Todd's sort of unique differentiator is this very operational excellence. Sort of. I mean, to build your first business, it's like there's all these people, all these moving parts, right? And in the lending business, probably maybe fewer people,
Correct.
But maybe more moving parts in many ways. So would you say that really has been the secret to your success, is just being very process oriented? I mean, big picture thinker, but realizes like devil's in the details. And that's what it takes to grow and scale these sorts of operations?
So this is, I'm really unique in this. I haven't fed anybody else, and I'm trying to make my head sound too big here, but candidly, I'm one of the few people that is a licensed contractor, is a licensed broker, and is also a licensed lender. I have personally, myself, fixed and flipped over $100 million of real estate. I've done that. Yeah. I'm a licensed contractor. You name it, I've seen it. Fire damage, water damage, drug houses I've been shot at. I've taken over meth houses. I've taken over squatters, police, SWAT team takeovers. You name it, I've seen it, I've done it. I have fixed and flipped over $100 million. At the same time, I'm also a broker. We've been involved multiple transactions, both on the seller and the buyer side. And at the same time, I'm a lender, originating nearly $1 billion. So when I speak with some of my competitors at conferences or at CEO speaking segments, I've got one coming up in Dana Point here in 2 weeks. I don't want to be disrespectful, but a lot of these guys, suit and tie guys, right, haven't actually done that. They're not a contractor. They actually haven't rehabbed. They're more finance guys. I have exposure in actually doing this with boots on the ground, actually at properties. We have 6 or 7 properties underway right now. We've actually been a brokerage on both the buying and selling, and we're an actual lender. So I have a wide swath of experience in all facets. And with that, I'm very process orientated. To your point, I developed the process based on my firsthand knowledge of those, and that's what keeps us out of trouble. A lot of our 85% declines for loan submissions are projects that I know for a fact are simply unfeasible. The rehab is too much. The rehab componentry is in an asset that's not going to do add-on value. Concrete, roofing, whatever, those don't do add-on value. So the rehab is too much, or it's too little. The days of just paint and carpet don't do it. You can't buy it, sell it, pay those costs and commissions, pay the lender, and just paint and carpet and make money. So there's this sweet spot of experience that I have of what works and what doesn't work. I can pinpoint it relatively quickly because I've done it. And so I developed that process from that knowledge base that my team here then carries out. And we just do that over and over and over again. Lance, I don't get into things that I'm not very knowledgeable on. I don't do funeral homes. I don't do car washes. I don't do agriculture. I don't know those spaces very well. I tend to focus on what I know very, very well and just do that over and over and over again. I call it my McDonald's hamburger flipping theory. The McDonald's hamburger is so simple, and I just flip a lot of them and get them through the drive-through window. And that's kind of how my philosophy is. There's a process to it. It's a very simple product. I already know where the pitfalls are because we've done so much in this space. And so I just tend to focus on that process from my knowledge base. That protects my investors. Principal protection is the number one key here, and it protects my money. So, which is in with my investors. So
it does. And I think
that
gives
a little bit of flavor.
You can't, and I mean, I say this all the time too. Like, I'm not good at most things, but I've spent an inordinate amount of time, like yourself.
I'm not either.
A handful of very specific things. So, and it's the same thing as I'm saying, hey, maybe
Yes.
I'm technically slower than everybody else, but I've spent more time doing it. And so, maybe you can get where I am in half the time it took me to get there. But nonetheless, what I have is I've got seat time and cycles, right? And I think it's the same with you. But I would say that there are others who have a lot of experience and have been committed, and multidisciplinary and within a certain thing. But I find that a lot of people in those positions really struggle with that delegation component of it, right? Of actually then saying, well, I take all this experience, I create a process, and then actually delegating it to others and systematizing it, the McDonald's sort of, theory of things. And so it seems to me that because that's how you grow and scale, right? It's
Absolutely. You have to develop that process, systemize it, and then make it relatively easy, for lack of a better term, for somebody below you that can be delegated to and carried out, where they feel professional and personal growth in doing that.
Yeah, because
so that becomes the trick of the trade. Is how do you do that, right?
Todd isn't the one who's reviewing at this point in time these packages and saying, no, it's a process and a system that's doing that. Yeah, and your
process
the
and a system
of that, but it's very systematic. And then I think that's what's important, is to say, okay, on its face, when you look at a private lender and they are originating loans in multiple states, right? It should be and is a red flag on its face, meaning you need to say, okay, how are they doing that? Yeah.
Correct. How are you good?
Yeah.
How are you good at all this everywhere? And how did you systemize that to be good at that everywhere? When I look at other lenders and they're in all 50 states, and by the way, they're doing everything, that scares me. I mean, how can you be good at grocery store lending, funeral home lending, commercial, industrial, railroads in all 50 states? I've already been through that. It's very, very difficult to be that good and then also systemize that and process that for your people to carry out. I don't know how you can do that. I just do what I know really, really well, and I'm actually really bad at a lot of other things. I don't know how to fix my car, and computers I'm terrible at, and there's many other things I'm not very good at. So I just don't do that stuff. We have an IT department, and they do that because I really suck at that.
Because
cars,
you are a hard copy guy. You're the paper guy. Let me run to the printer real quick, and of course you can't get.
I'm the paper guy. I'm really bad with that. And in cars, if it's not the battery or the gas, I'm stuck there too. There's plenty of things, but there's so many things I'm not really that great at. But I do know rehabbing. I've done a lot of that, and I do know the states that we're in. I know those communities, and I know they're non-judicial, and so that's how that's been replicated. And I just stay. It's very, very specific. I just stay to single-family residents below the median cost of housing in well-defined communities, because I know that property, if I have to, in the issuance of a default, I can get to the property quickly and take a crew there, which we've done. Take a crew there, we transplant them there, put them up in hotels, and we can get in and out of that, and typically in about 3 months. So I'm very comfortable with that. And when people call here all day long, wanting us to do this or do that, I just stray away from that. This is, it's too risky. I don't like it, and we're not very good at it. We're not very good at those other things. They're too complex to understand. They're too difficult to understand. It's not something I really want to choose to do. Agriculture is very difficult. Do you have water? Do you have water rights? How's the well working? What's the demand for the crops? What's the demand for those crops overseas compared to here? There's all those things that you need to understand. You just can't look at an appraisal and go, it's worth $3 million. Let's sell on 2.5. I don't know how. You have all these other metrics on agriculture that you better understand if you're going to take somebody else's money and put it in there. So I only like to do something that I really feel expert in, and just stay with my niche. If that helps.
I'm sure you haven't taken the time to listen to every episode of this particular podcast, but I mean, I think that is the theme that emerges, right? And I call it conviction. Is that there's no right answer, but what you're looking for, the signal you're looking for when investing in the private capital markets, is conviction. That's what I mean. It's like, it's your formula. It's Todd's formula. It's ZINC's formula. It's what you do. There's a reason why you do it. And it's, if you dig, but those are the questions that you really want to get clarity on, because, right. Because once again, if it's not there, then to me, and you keep mentioning it, it's that it equals additional risk. So as an investor, it's not to say you won't maybe choose to put money in there, but you better make sure that you're being compensated for that additional risk, right? Because that's what it means. Lack of experience, lack of focus, lack of whatever it is. If they don't have good answers or a lot of conviction and things that sort of tie it up, then all it is more risk. So then you say, well, are you going to compensate me more for that risk? And then that's where, just the good old free market kicks in, because more often than not, there's not enough premium, right? Like there's not enough there to compensate you appropriately for the risks that are being taken. That's investing.
So I have two thoughts on that. Number one, and if you really pull the number of funds out there, or the number of mutual funds, stocks, or whatever, it's actually really interesting. A lot of the people running these things aren't actually financially invested in the very product they're selling. I have my cash in our fund. I have my cash in these houses. I have my cash with these investors. This is my money. Yeah. So number one, I'm invested right there with these guys, right there next to my investors, and a lot of other fund managers out there, from mutual funds to broad range of investments out there. My father's a stockbroker. My father manages hundreds of millions of dollars in investments in mutual funds and other things. It's really shocking when you actually look at the fund manager or the mutual fund manager. They're not actually invested in it. They're just running it. It's actually scary. So number one, I'm invested with my investors here, with my own money. So that product that comes down the conveyor belt must work, because I don't want to lose my money. It must work. It really is a big difference that I have put my money up right with yours. But I have a second thing on the risk model. And this is really, it's a little bit difficult to tell you, but look, all we get is yield. All we get is yield. So at the end of the day, when I look at risk, all we get is a coupon rate. There's really no way to price per se for that much more additional risk. If the guy's got terrible credit and it's a terrible project, I get people all the time. Hey Todd, we'll pay you 14%, 16%, whatever the number is. I don't want your 14% or 16% because the risk is so much is magnified so much more. All we get is coupon. There's no way to even price for it, candidly. You can't price for this dog doo-doo you're bringing me. It doesn't work, because all I get is coupon rate. And I try to explain to my staff, this project, our coupon rate is 9%. You can pay me 14%, and that sounds wonderful, but it's 5% of 200 grand. It's like 10 grand over a year. But the risk is a project that could cost me 50 to 100 grand in losses. It's simply, there's really no way in my world that you can price it accordingly for the amount of risks. You're better off with a good borrower, with good credit, with good liquidity, with a good project, and just pricing it appropriately and going to sleep every night and having a good night's sleep and waking up knowing your investors' money's protected, my own money that's with my investors' money's protected, is protected. Make a fair profit, move on down the road. These other lenders that price
it's a great
risk,
point.
I think, is foolish. There's no way to price for that risk.
See, when you go there and then you actually take it all the way down, you land where you said is that it's you can't compensate me enough. That's the issue. It's a slippery slope. Once it goes down, it's gone. It's a dead deal. It doesn't make sense. And that's
it's terrible, man. I've already did those. In the late 90s and early 2000s, I did those loans at 15.99 and 17, whatever the rate was. Horrible, disastrous consequences. All of them losers, and the losses were not the yield. The losses were attorney's fees, litigation, market conditions. The property sits, it becomes infested with squatters, deterioration of the property becomes red tagged by the county, and now you're dealing with red tag code violation, broken windows, broken sprinklers, deferred maintenance, the borrower's a mess, bankruptcy, on and on and on, serial bankruptcies, multiple bankruptcies in a row throughout an LLC. I've seen it all, I've been through it all, and I don't do those because there's no way you can price for that asset or that borrower that is F. It doesn't work. So when I see these people invest, it's really sad. It's really sad when I see these investors that try to chase that higher yield for additional risk. It bites them over and over and over again. It's not worth it. You cannot price enough for that additional risk. It's just not worth it.
Like, it's the same thing. It's just that's what makes it hard. It's like risk adjusted. This risk adjusted 7. I mean, like that's a solid 7. 7 is whatever to go and chase, like you said, to get 100 basis points, 150 basis points more. I mean, like you said, it's just it's the two aren't even in the same stratosphere. I mean, yeah.
They're not even in the same. They're not. I have a friend of mine, and I wouldn't. Well, I actually won't call him a friend. He's an acquaintance, and he does these high risk loans. He charges 5 to 10 points, 15, 16, 99. I mean, a third of his stuff is in foreclosure. A third of it is defaulted. The investors lose money. It's just a terrible, terrible product. I would never put somebody in that kind of product. I don't want it. There's just no way. It just doesn't work. Right. It doesn't work. It's not a sustainable platform for lending. It's not.
The nuances, right? And the things you got to dig into and think about. But that's what I mean is like, and I think the key thing is like, hey, especially when it's your money. Right, like now it's your money, so of course you have to agree that you know what it is. Like, but this is what investors need to realize is that it's your money. It's your money going into someone else who may, once again, may or may not have any of their own money in it. Especially when they don't have any money in it. It just, and even when they do, sometimes it's that lack of experience or that naivete or those things. But once again, you have to flesh those things out. You can't just be drawn to the number. The number is a starting point for a conversation. It's interesting. You're saying you can deliver me a 14% return. That's all it is. It's just, it's a number, and you now need to begin the investigation to figure out how in the hell are you planning on delivering? How much risk am I going to have to take on to get a 14% return? Right. And
your risk goes up 10x for every 100 basis points more you're getting. It's just an inverse relationship, and it's just a slippery slope. I mean, to go up 200 more basis points in yield, you're taking on 10x in risk. It's really not worth it. This is kind of unimportant, but I'll touch on this just real quickly, and because it's so foundationally important for me. When I started my first company, I started with $17. I had no money. I was broke. My mom was on welfare. It was really, really bad. I had no checking, no savings. I'd withdrawn from Fresno State. I took that $17 and I started my company, and then I got to 43 with the produce company. Then I got to 63 with the construction company. By the third month, I'd raised $300. By the fifth month, I got to $810. I built that company to 500 employees over a 17-year period in 3 states into a multi-million-dollar company that started with a $17 guy broke on the side of the road in a 1972 Ford pickup truck. That's how I started. And I will tell you, I worked 7 days a week for over a period of a decade, working 80 hours a week. I cleaned bus stops, I did Targets, I did Mervyn's. My point to you is this, Lance. I worked 7 days a week for 10 years. My work week started at 4:30 in the morning on Saturday and ended at 11 o'clock at night at Dr. Terry Loeffler's office. And so that's about a 35-hour weekend, and that's how I started. So the point is that I busted my hump for every dollar I got. I didn't win the lottery. I didn't inherit money. I started with $17 that went to 43, 63, and 810 with Spano Enterprises by my 8th month in business. So when I put my money, which is now millions, I put my money alongside my investors, I'm very, very careful with it. Very careful with it. It is only going to go into a product that I fully understand with the appropriate risk. Because I sure as crap don't want to lose what took me years of working those kinds of hours to build. So when I see these loans at 14 and 16 for $300,000, it took me forever to create that back in the days, working those 7 days a week. And my investors did the same thing. They're all business owners. None of them inherited or lottery. None of them. They're all business owners. So gosh darn, if I want to put $500,000 into a loan, it's going to have to meet my process and that I've delegated because I don't want to lose that money. And when you do it in a 14% loan or a high risk loan for some extra basis points or extra fee,
Yeah.
I don't want the extra fee. I want a performing loan because that's my money that's in there. So it just, I'm sorry to take up time on that, but I think it's a really important concept. People worked very hard for their money. They're investing in this. That the loan has to perform.
Yeah, no, I agree.
And I think
a
that's
lot
just
of people
a critical pillar of how we operate here.
Boats, and that's what I mean. It's like you've got to dig in deeper. Yeah, that's right. It doesn't necessarily mean that
the rising tide lifts all boats, and we have appreciation.
Riding the tide.
It's really easy to look good on that roller coaster when it keeps climbing to the top, but that roller coaster is going to come down, and how do you look in it then? So right now we've been on rising tide for the last several years at a very high appreciation level, but it's going to flatten, and it may go down.
Yeah.
And so if it goes down, how are you mitigating that risk for protection of principal? And so those factors are just non-negotiable in our underwriting because that day is coming. And so we have to be well positioned to absorb that.
Yeah.
And it's not worth additional market share today, and it's not worth additional perceived yield or basis point yield, perceived, because you're not going to get it. Perceived for that additional risk, it's not worth it. But when you go out and had to really work hard for that money to put in that loan,
you've earned it. That's what
it's a different feeling, Lance.
When you go and you love making loans or buying property or whatever, but when you go and offer to somebody else, it's a financial product that you're offering someone, and you're asking them to invest their hard-earned money into it. The money they work their tail off to get. Once again, whether they inherit it or not, it doesn't matter. You assume that they were working 60, 80 hours a week because that's what it is. It's freaking money. I tell people that too all the time. Like, you have to understand, it's like most people will let you watch a stranger watch their kid for an hour or two before they'll give you, invest their money with you. Right? I mean, money is emotional, right? And
it is everything. They'll give you their dog, their pet, their wife. You can have my wife, don't touch my money. It is something really important to most people, so I get it. What it represents is a lot of sweat, tears, and weekends. And so I understand that. So do my investors. And I want to continue with that thread. And I have to remind our staff here, Lance, don't kid yourself, man. Our staff here, even, our loan officers or under, they forget too. They throw around $100,000 bills like they're water. We're a lender, but you have to understand that $100,000 or $500 or $1 million represents a tremendous amount of work for somebody. So we have to be mindful of what that means. And go after the appropriate yield. I agree. No question.
I'm glad we got you on.
But let's not take undue risks because it's not worth it.
Always go this way. But now we finally got it. We've got it recorded for the benefit of others. So thank you so much for your time. Where can people learn more about what you're doing over at ZINC Financial?
Absolutely great. Todd Pigott, ZINC Financial. You can find us at zinc.net, ZINC.net. That's our main website. We also have zincinvesting.com. We launched the ZINC Income Fund. That is a mortgage fund with a sub-REIT feature that allows tax benefits for our investors. So I would invite anybody that wants to learn more about me to give me a phone call, 559-326-2509, or they can visit us at zinc.net or zincinvesting.com. And Lance, I really enjoyed you having me here today. It was a joy.
My pleasure, Todd. Take care.
Thanks for taking time and spending it with me. I mean that sincerely.